Or to the cloud.
Hello, this is Jordan Marhefka, and on behalf of myself, Dan Youngs, and the team here at HFG Financial Group, I'd like to welcome you to our 2024 fourth quarter economic review. At our firm, we partner with our clients and believe an educated client is our best client. While we'll always try to help you best with your finances, we believe that knowledge is power, and one of our missions is to share any knowledge with clients to help them make informed decisions.
As you can see from the charts, the fourth quarter was a roller coaster of a ride for investors. The market remained highly sensitive to good news and bad news that kept us on our toes, including lower interest rates. Needless to say, the last quarter of 2024 was not a smooth ride by any means and was volatile. While the fourth quarter was not as sensational as the previous quarters, the S&P 500 ended the year up 23%, and the Dow ended up the year 13%. Inflation remained stubborn in November. The year-over-year consumer price index, CPI, was 2.7%. The core CPI, that's excluding food and energy, was up 3.3 year over year. A major contributor to these sticky numbers was the cost of housing, which saw a significant increase in the fourth quarter. While inflation is gradually moving towards the 2% target, the persistent nature of inflation and certain proposed economic policies may lead the Fed to slow its easing efforts in 2025.
When we're talking about interest rates, the Fed made a 0.5% reduction in September, and then they cut interest rates 0.25% twice in the fourth quarter of 2024. So that brings it to 3 rate cuts on the year. And these were the first changes since we saw 11 rate increases from March 2022 to July 2023. And these decisions to lower interest rates came in response to key indicators suggesting that economic activity continued to grow at a solid pace while unemployment rates remain low. Typically, the market responds pretty well to interest rate cuts. However, during the December meeting, Fed Chair Jay Powell indicated there might be fewer rate cuts in 2025. So the market um, saw a quick decline in the equity markets just based on that. Interest rates and inflation obviously play a crucial role in investors' financial planning. Therefore, we'll continue to monitor any changes and keep you informed about these indicators. As far as the global economy, it faced global uncertainty during the fourth quarter. These global tensions remained high, particularly due to the Russia-Ukraine war and unrest in the Middle East. Additionally, as we all know, a new president was elected during this period, marking the end of a contentious campaign season. And initially, though, the markets did react positive to the election results. With some of these anticipated changes in economic policy, tax laws coming up, there are several key areas for us to monitor. And it's important to remember that corporate earnings and the overall economy are the primary drivers of financial markets, and we are dedicated to staying informed about any changes that might impact your situation.
Although there is still a lot of uncertainty in the economy, we are still currently experiencing a bull market. This bull market began in June of 2023 after the S&P 500 rose 20% from its lows in October of 2022. Recent years have been strong for U.S. stocks, but inflation looms as a key concern in 2025. While analysts are split, many expect a market rally driven by AI growth, deregulation, and potential stock cuts, especially if interest rates decline. Others worry about a possible market correction. When the S&P drops over 10% from its highs, it's termed a correction. As such, declines often realign prices with long-term trends. Since 1974, there have been 24 corrections occurring on the average of every 18 months. Though none happened in 2024, analysts view corrections as healthy for bull markets, helping to temper overheated prices despite potential volatility. Strategists remain optimistic about equities in 2025, projecting solid earnings growth and an overall upward trend. So, key takeaways. As a recap, here are some things to remember. 2024 was a strong year for the markets and left investors with positive returns. The U.S. economy has been strong, and long-term investors were rewarded with significant returns. The Fed reduced the Fed funds rates range three times in 2024, with two being in the fourth quarter. Inflation pressures are still stubborn. 2025 brings a host of challenges which create uncertainty and market volatility. The key items will be keeping a close eye on include proposed tax changes, proposed tariffs, monetary policy changes, stubborn inflation rates, and geopolitical issues. Be well prepared, maintain the consistency of a well diversified, long term focused plan has historically served investors well.
We are grateful for our clients and always value the opportunity to accompany you on your financial journey. And our goal is to assist more people like you. The highest compliment we receive is when our clients refer their friends and family to us. So if you have anybody you want to add to our mailing list or is looking for a financial checkup, we'd be glad to talk with him. Once again, thank you for your trust in us. And our main objective is to keep our clients informed. And we appreciate you taking the time to watch us update. Feel free to reach out if you have any questions.